Japan, another important developed market. I'll first go through the economic part. It's just to let you know that how the Japan economy is doing, and then I'll probably share the thematic view that we have, which is different from what's happening within the economic side. So economically is supposed to grow by 1%, quite weak. Business confidence has slightly improved, recovered just now, but it's not that what the expectations were like last year or so. Machine orders has remained subdued. Current account has remained positive, but that's because of the low oil price. They import a lot of oil these days. Their nuclear plants are shut off, and so they import a lot of oil. Inflation remains low at around 0.8%. Yen might further depreciate for the second half of this year, and then the key risk is always there that we keep talking about, that the Abenomics, the structural reforms and stuff, and we haven't seen any aggressive structural reforms yet. So that's one thing. So in short, in simple words, Japanese economy is weak, but we still are quite positive in the Japanese market. And by market, I mean the stock market. And why is that so? It's because we believe that the fund flowing into the financial market right now in Japan is more important than the economy. There's few things that you want to know. Number one is the BOJ. So BOJ, they came up with this QQE, qualitative and quantitative easing, where they're buying not only the bonds, but they're buying the ETFs. So what they're doing is that they're buying their own stocks, and that's helping the market to go up. And they're buying at a pace of around $25 billion a year. It's a lot. And so when you look into the economy and you think, okay, probably I should like go against or maybe underweight, short sell or whatever the Japanese market, the fund flowing will tell you the other story, and I think that is the more important thing. Another important stuff, these Japanese pension funds, which are huge, the biggest pension fund is the GPIF, and they have already doubled their asset allocation. So last time it used to be domestic Japanese equity was 12%, now it's 25%. Many of the other pension funds are following the same, they are copying the same asset allocation model, means they will be increasing their domestic Japanese equity allocation as well. Means they'll be going into the market and buying. These are like the structural demands, so you don't want to go against these structural demands. These are like big banks, like the central banks and the big pension funds. They are buying, they are putting in money into the market, so you don't want to go against them. Foreign investors are the key. If I'm not wrong, it counts for around 60% of the total volume of Nikkei. So foreign investors are quite the key, and they have been very positive. You might see here that most of the latest ones are quite positive. The reason for so is that there are a few corporate reforms going on, like the corporate governance and then the lowering of corporate tax rate. For decades and decades, the problem with Japan is that if an employee is being hired in Japanese companies, right, these companies cannot fire him. So if he goes into a company, gets hired, and then if he doesn't really work, he will still be paid. And that was the problem, major problem, because you can't fire a underachiever or underperformer. And now we're working on that, so it's a good thing, and that is the reason these foreign investors are going into the market. Valuation-wise, is still below the historical average. PE ratio is better than the US or the China right now. So the corporate earnings for last quarter was managed to beat the expectation, and so are the expectations for this for the last quarter as well. That they will start the earnings announcements. So we remain quite positive on the Japanese economy. So far, Japanese and US need to take into a technical analysis a lot, but for Japan, it's more of like just get in and then go with the flow. But yeah, and Eurozone is like quite sketchy at this point of time. If you are like kind of those gamblers who want to like gamble but throw in money, then probably Europe might be, because it's quite the news driven. So if you hear a news that okay the vote was yes and then everything is resolved, you will see some sharp rally. If it's the other way, you would probably continue to see the volatility. And you would notice that this has brought a lot of volatility into other markets as well, like China. 2 days ago, the Shanghai Composite Index, I think, went up to like 6-7%. The very next day was like down 5%. And so, unless you are good enough to understand the market, it's quite difficult, because if you go on the wrong way, let's say the market went up 5% and you were down, and then it went up the day when there was some bad news from Greece, you might have got hit by around like 12% within 2 days. But China, if you look into the economy-wise, you would see, I don't even have to speak when it comes to China, because you will see the chart will speak for itself. Everything is down. So GDP is going down, and we know why. It says 7%, but I think it's below 7%. It will be below. Yeah, it's because it's China, right? So it's not so much transparent. So they keep. There's a funny joke about that. The politicians, they sit together on a round table, and then the person asks, okay, how much do you think? And the person said 7%. The next person, okay, how much do you think? I think 7.1%. And so they just took, okay, we pick 7% or 7.1%. But thing is, China is slowing down, and you would see that effect on the commodities, hard commodities as well. And so this is not a known fact. But the PMI, if you look into the service sector, is resilient. Manufacturing sector is improving, but it's still far from normal. Retail sales is improving. So there are two separate things. GDP is going down, but the consumer growth is there, is improving. And there's one company that I would share with, which has this consumer retail sales part of it. Wait. Okay. But not all news are bad in China. China long-term, right, is quite something that you want to be in for next few years. But then you need to like understand what's happening at this point of time, because you don't want to lock your money in and then not earn anything for next couple of months or year. Doesn't make sense. Property market has been bottoming out, as you might see here. But it's still quite. You would see from the top here is down here, and then there are few good major changes in terms of the policies and in terms of reform, which are quite positive when it comes from China. They have introduced this government debt swap plan, which is kind of like, so these municipalities have issued loans to companies and banks and stuff. They will be now issuing bonds instead of those loans, and these bonds will be backed by the Beijing government. So it will. The aim is to reduce the shadow banking, because every now and then, every 1 year or two, you will hear this shadow banking thing, and then it has been looming over for so many years, and then every time the market rallies, and then there's news on this. Oh, shadow banking is getting serious. But the government, the Beijing government, is taking this very seriously, and they are introducing reforms like this. So, and you would also need to appreciate that the goal for China is to change from investment-driven economy to more of like consumer-driven economy, like what US is. US is like 70% is consumer-driven. So China wants to shift from because investment-driven economy is more like those emerging markets, and they want to go into the developed market, which is more consumer-driven. So domestic market is the most important market. It will take time, and you will not see double-digit growth anymore. Uh, so we remain, for now, the market has already gone up a lot based on number of factors. Yeah, you will see the chart here. The Chinese, right. You will see the, yeah, you would see the chart here, which has already gone up, and now it's too volatile. So you need to, again, here in the Chinese market, you need to take a look into a good point to get in. Maybe a good correction, a significant correction might be a good point. Because honestly speaking, the Shanghai Composite is quite overvalued in terms of the PE numbers. And we, as a department, we believe that H shares are more attractive compared to A shares in terms of fundamentals and valuations. So, okay, it looks like I need to pick up my pace. India. Within the emerging market in Singapore is the sweet spot. We are quite positive on the Indian economy for many reasons. The biggest problem for India was the inflation that was uncontrollable. Right now it's under controllable, it's within their target, and they have already reduced their interest rate to 7.25%, which is a good thing because India wants more investment. The recent budget hasn't been what the expectations were, but if you look into other markets, and I will be talking a lot about like Indonesia and in Malaysia and stuff, that the reforms within the Indian market has been the most significant compared to the rest of the emerging markets. And people used to compare Modi, the Prime Minister of India, with Joko Widodo. And when you talk about the reforms, it's the total different story now. You talk about the infrastructure projects, India is somewhere here, Indonesia has gone like down somewhere there. So, in terms of infrastructure product, infrastructure development, in terms of manufacturing, they are going with this the model of like Made in India campaign that we are going to make things here in India and then export. So, Indian as a market has been, and if you look into the stock market has been quite resilient, going up for since last year's election. So, and you will see these uptrends in the like industrial production is picking up. The GDP has risen up significantly, and most likely the GDP of India would be better than China this year. So this is what we prefer. Indonesia is the total, like I said, total opposite story. So a lot of things, when the elections were going on, people were comparing Joko Widodo with Modi, that okay, both were kind of the same nature, that they were investment driven, so they thought that he will bring more investment into the Indonesian market. Unfortunately, it hasn't been so. And if you would read news within the party, there has been some divisions between Joko Widodo and the Megawati, and so it's not helping. If you look into the data, the economic data here, you would see that the FDI is slowing. So FDI, just to mention here, FDI, which is the foreign direct investment, has been flowing. So the money is flowing out of US, has been flowing out of these emerging markets, and is flowing into the Japanese and Europe market. Something you need to know. So Japanese and Europe market is where the money is flowing in. Most of the emerging markets, the money is flowing out, except few of these like India, because most of these emerging markets are not doing well compared to the developed markets. So it doesn't really make sense. You need the premium in order to get this emerging market, and if you don't get it, what's the point in taking such a risk here? The state government spending is slower, and so it's kind of hampering the growth as well. When the elections were going on, there was a lot of talk about reforms and so many reforms. What kind of reforms have you heard from Indonesia? Maybe some small ones, but then no major ones. I mean, there was so much talk reforms. Joko Widodo, I will bring reforms and stuff, but there's no such thing anymore. And when you talk, I can talk a lot, but the funny thing is that the chart should be able to help my point. And I don't even have to like talk because you see the chart and you know what's happening in Indonesia or what's happening in China. So, and there was the reason I put up so many charts here, so that probably would be easier for me to explain rather than I just keep talking and talking, and then you put most of you to sleep. So, like I said, capital flowing out. External factors are that when interest rate will start to increase in US, and very basic theoretical stuff, that when US increase the interest rate, there has to be interest rate parity, and the interest rate, if they are low compared to the inflation and stuff, investors would want the money to flow into US because now they can earn more putting into the treasuries or bonds because the interest rate will go up. So that's one factor, but not so much important, to be honest. I mean, I did not talk a lot about the interest, the lift off when I was talking about US, because there's, to be honest, not much to be talked about. It's something like QE. So if you are kind of like investors who have been monitoring the market and you were there when the QE tapering thing started, you will notice that every news channel, every newspaper has this QE tapering stuff going on. Oh, this will be so bad. You know, market will collapse and things. Nothing happened. Maybe for a short term, it did have a negative effect, but we all know that the U.S. lift off this interest rate normalization is, the word normalization means has to, that's a normal thing. So right now it's abnormally low, which is not sustainable. And going up means that the economy is improving. Last time the tightening of the interest rate was back in 2004. And you would see and you would know if you read the market or at least monitor it, that what happened between 2004 to 2007, the market rallied. And that was the time when interest rate was going on. I mean, they had put 1%, that was the minimum they had for between 2001 to 2004. And then when they started increase from 2004 onwards, the market rallied like crazy. And so you read a lot of news, I read a lot of news as well, but then sometimes you need to look back and need to understand what happened previously, and then most likely that's gonna be the scenario. So short-term wise, yeah, when they announce maybe in September and December, 1 or 2 days, the market might go down. And I already show you the technical part where it gives kind of a bearish signal, you know, already. So not so much important, but the most important here is the internal one, which is the winning economy. If the economy is not doing well, and the problem with Indonesia and even the Malaysia is that they export a lot of commodities. And if you look into the commodity side, the price has been down for like a year or so, and that's affecting their export. That's affecting their growth as well, because the formula for GDP in very simple is CDI and then the net export. So for let's say US, we see the consumption is the most important part. For India and China, the I, which is the investment, is the most important part. And then there are like few exporting countries, which includes Indonesia as well and Malaysia, in which the net export is the most important part. And if the price goes down, definitely the value of the net export goes down as well. And so that's affecting them. And it's really hard to say that the commodities price in general will rebound and will go up in near future. So that's something. And then another problem with Indonesia right now has been with number of problems. Another important problem here is that the rupiah is weakening, just like the ringgit as well, and I'll talk about that as well. And then one side, rupiah is a depreciation, and on the other side, there's rising inflation. How do you counter effect this thing? Most likely, if the inflation is going up, most likely you would have to increase the interest rate to counteract this thing. You increase the interest rate, economy, GDP is already down, it will go further down because you are increasing the interest rate, you are putting pressure on the growth. the growth will go down. So that's something about, so reading news is quite good and quite important, but sometimes news, right, is more about like what's happening, and then they don't really analyze things. But when you look into the economies in the market, you need to analyze these numbers and feel the things so that it helps you to make a better judgment. Okay, time. Yeah, I'm running out of time, so try to be. That's the problem with me. I talk a lot, so yeah. So usually when I'm given like 40 minutes, I would like talk for an hour and a half, and then other people complaining. Talent. One simple word. Bad place to be. Okay, not one simple word. One sentence. Bad place to be in. Politically, nothing has changed. Nothing. No election. We don't foresee any election in the near future as well. Export, import, everything falling. Slow state spending, same as like Indonesia. Highly leveraged. No consumption. So I wouldn't like waste my time talking about talent, because, like I said, it's not something we are positive about. It's negative. Okay. And then the weak part. What else do you want? So yeah, I'll just move on. Malaysia. Again, a lot of things, a lot of problems. That's why, like I said, when you talk about Southeast Asia right now, it's not a good place to be in. Yeah, but I have to cover Southeast Asia, because if you're living in Singapore, you can't just talk about US, Europe, and Japan, and then step down and then okay, bye. Because people want to hear about these economies and countries. So weak commodity prices, like I said, affecting their current account as well. This down. GDP is quite flat. You might see here, and the quarter-and-quarter change actually is the gray color one. If you can see from there, it's going down. They have introduced the GST, which will further put pressure on the consumption power, and so the consumption will further decrease. They had to do it because they had no other choice. They need to kind of balance their fiscal deficit as well. So when you have a lot of trouble going on, there's troubles from all sides, not only from the fiscal side, but from the trade side as well, and then the ringgit. Those who are holding ringgit, they would know, and I wouldn't need to talk what happened to ringgit in the last couple of weeks or months. It has depreciated by margin, and then we still believe that probably will continue to do so. So currency-wise, I think it's better to hold US dollar. That's going to appreciate in the long run. Yeah. Singapore. Yeah, I must not say any bad things about Singapore because there's a lot of Singaporeans here. So I would say you are quite neutral. Yeah. So what I'm going to do is I'm going to show you some charts instead of talking crap about Singapore. So that's not what I don't want to do. I like Singapore. I've been here for the last 8 years. So, yeah, so trust me. The GDP has been flattening. You can see here, and most of us might read those Strait Times, and we would know that what's happening in the economy side is not. It's growing at a very, very small pace. I mean, that is one thing, but the important thing for many of us is that there's a labor market is tightening. So there's a lot of jobs. Yeah, it's a good thing, right? So it will keep the wage push up, so you might have some increment in a couple of months. Domestic structural changes is pushing the business costs up, but the most important thing is that global deflationary pressure, right? You will see that the inflation within U.S. or Europe side or Japan or even in China it's not much. So there's a global deflationary pressure and overall, and so that will help to balance the prices within Singapore. And you will see a lot like the rents have gone down. We will not see. At least I don't notice inflation at this point of time. I mean, like, just speaking about like my own personal experience. Yeah, the inflation is like CPI is basically the inflation. So you would see that this is quite flat here. The red line is the USD versus SGD, and so we know that SGD has been weakening, and that's why I said that US dollar is something that if you want to put your money in, probably US dollar will be something, at least for next couple of quarters or maybe years. So, externally oriented sector should bode well, because when the growth picks up in G3, that is the most important market, like the Japan, Europe, and US. And you will notice that the Singapore market follows a lot of like what US market does. So, I checked, I think last time, a couple of months ago, there's a good correlation actually. Of course, it might go opposite during certain phases, but overall, there's a good correlation. Major infrastructure projects to support the economy growth. Like I said, the growth will be quite tepid. Downside risk is the currency thing that I showed you. And again, for Singapore, because I like Singapore so much, so I have this technical chart as well. You will see that the MACD, right? In US case, there was a divergence. Here is already negative. So it's negative is like a bearish signal. So it's already negative. You look into the chart, and you would notice here a few important points here is that again here the lower the most recent low, the low is the lowest compared to the previous one, and the high hasn't been able to breach this what you call the 200, the long-term moving average. So the long-term moving average, what you see here is something what the resistance is. And if you draw a line, the support will be this probably this level. And so if it breaches this level, probably it will be more. It already is. The MACD already gives a very bearish signal, but if it breaches, it will be a confirm of this bearish cycle for STI. And like I said, it follows a lot of US and major news, so you probably want to be quite updated. Maybe tomorrow, by night, you should hear what happens in the Middle East, and then by Monday morning, that will kind of drive most of the markets. So at the very end, here I have a very nice chart where we have suggested few unit trusts or ETF that have exposures into these markets. And here you will notice that overweight, neutral weight, and underweight. Actually, these ratings are not for the market ratings. It's more of the economic. So overweight mostly means positive, and underweight means negative, and the neutral is like that we would probably stay away. You know, there's not much potential within the economy. So there are a few. You can take a look. Those of you who want to take a picture of this, this is some of the good ETFs and some of the good unit trusts that have exposure to these markets. And the most important, the overweights will be the ones you might want to take a look into, like US, Japan, China. China, like I said, you need to look into the valuations. Right now, the valuations are too high to be true.